Alright, today I'm here with my business partner Mark, and we're going to talk about if the Bank of Canada drops interest rate to counter an internal recession while the Canadian dollar is already weak, what would be the outcome on the Canadian economy and subsequently on the real estate market. Alright, I'm here with Mark. Welcome Mark, and welcome to this show.
Thank you so much. Happy New Year everybody, and all the best.
Thank you, Mark. So we are going to discuss the outcomes that we already know that's going to affect the consumers, businesses, and the broader economy in both positive and negative ways. So first of all, we're going to discuss the positive outcomes of cutting rate while the Canadian dollar is weak. The first outcome, which is a positive outcome, is the boost in domestic economic activity. So lower borrowing costs or reduced interest rates would make mortgages, personal loans, and business loans more affordable. This could encourage spending on homes, cars, and other big ticket items, as well as investments by businesses.
It can stimulate the housing market. Real estate, being a key driver of our Canadian economy, will likely see increased activity. Lowered mortgage rates can entice buyers, particularly first-time homeowners entering the marketplace, potentially stabilizing or even boosting home prices.
And it also encourages cost consumer spending. With cheaper access to the credit, consumers may spend more on goods and services. That's going to help the businesses to recover from recession, and it's going to support the local job creation. So the second one is potential inflationary pressure. So the higher import costs, let's say a weaker Canadian dollar coupled with low interest rates, would make imported goods and services more expensive. So this includes essentials like food, electronics, and energy. The increased costs the result of that would also push inflation higher. That's going to reduce the purchasing power of Canadians eventually.
Another thing is a cost of living challenge for Canadians. For households already struggling with higher prices due to the weaker Canadian dollar and rising inflation, it can offset any of the benefits of the lower borrowing costs.
Another thing is that it's going to have an impact on exports and trades. So basically, it's going to give us a competitive advantage for exports. Of course, a lower Canadian dollar and reduced interest rates would make Canadian goods and services even more attractive to foreign buyers. This would provide a boost to export-driven industries like manufacturing, agriculture, and also natural resources and mining.
And also, it can increase demand for our commodities. Resource-rich provinces like Alberta and Saskatchewan might benefit as commodities like oil, lumber also become cheaper for international buyers, increasing a global demand for Canadian goods.
One thing that concerns some of you viewers is the capital outflows and investment concerns, which most of our viewers are, we assume that they are investors. So lower returns for investors is going to basically make the environment less attractive for this basically type of people. So reduced interest rates could discourage foreign and domestic investors from holding Canadian dollars and Canadian assets such as bonds or saving accounts. And due to lower returns, this is something that they're not gonna look into. This might lead to capital outflows and reduce basically foreign investment in the Canadian economy.
With the weaker Canadian dollar, if investors move capital out of Canada in search of higher returns elsewhere, it can further weaken the Canadian dollar, amplifying challenges of higher import costs and inflation.
Another important thing is that it's going to have strain effects on savings. So meaning that lower returns on saving, or let's put it that way, Canadians who rely on interest income from savings or fixed income investments such as retirees could see their returns diminish, and basically that's going to result in reducing disposable income for this demographic. That also brings the wealth gap concerns as well. While borrowers benefit from lower interest rates, savers may feel the pinch, and potentially it's going to widen the economic inequalities.
As well, there's a risk of asset bubbles, overheating in real estate. If borrowing becomes too cheap, there's a risk that speculative behavior becomes prominent in housing markets, which is something we've seen. This can also inflate home prices even further, especially in already expensive cities like Toronto, Hamilton, and Vancouver, making housing even less affordable for some Canadians.
And when it gets to the stock market, it's going to have basically a speculation effect. So meaning that cheap credit might also fuel excessive speculation in the stock market as well. And that's going to lead to overvaluations and the risk of the market corrections down the road.
As well as something for government debt dynamics, cheaper debt servicing with lower interest rates would make it more affordable for the federal and provincial governments to borrow more money and stimulate programs for the economy with infrastructure projects, as well as accelerating the economic recovery.
And it also has the increased public spending in it. So governments might, whether it's federal or provincial, might take advantage of lower borrowing costs to fund initiatives that support job creation and economic activity, renewable energy projects, or let's say affordable housing programs. So let's talk about the balancing the trade-offs, Mark.
Yes, the outcomes of a BOC rate cut or the Bank of Canada cutting rates in this scenario depend how effectively policymakers will balance these trade-offs.
Yeah, let's talk about these policies that can trade off the whole thing. So the first one that comes to mind is addressing inflation by politicians. So if inflation rises to the higher import cost, the Bank of Canada may need to introduce targeted fiscal policies like subsidies for essential goods to cushion basically consumers against these.
Another thing they might need to do is encourage investment. So governments could work to attract foreign investment by focusing on competitive sectors such as technology and green energy to counter capital outflow.
Another one could be boosting the exports. So meaning that the industries that are reliant on exports such as agriculture and manufacturing could benefit from supportive measures like tax incentives or infrastructure developments. So in order to wrap this whole thing up, Bank of Canada rate cut during an internal recession could provide a much needed economic stimulus, which is going to boost basically spending and exports and job creation. However, it also risks the higher inflation, weaker purchasing power, weaker Canadian dollar, and speculative bubbles in both real estate market or equities market, stock market, or such markets like crypto and stuff like that. So policymakers, in our opinion, would need to carefully manage these dynamics to maximize the benefit while minimizing the potential pitfalls of a weaker Canadian dollar and lower interest rates. So Mark, if you'd like to add anything to it, or if you want to say anything to our viewers in order to wrap this up.
No, nothing more to add. That was very informative, and we hope that you all take something from it. If you need any more information about any of the topics about the real estate market, Canadian dollar weakening or lower interest rates, and how we can help you make a strategy that benefits you in the marketplace, give us a call or send us an email.
Thank you, Mark. So if you enjoyed this video, or if this video brought any value to you, please share it with your friends and subscribe to our channel, and I wish you a great week ahead. Have a good day. Ciao.
Bye-bye.